Last night at 7:30 p.m. on the 12th of May 2026, the budget was announced, and a lot of property investors are right now, as we speak, are confused. And this video I'm making in the morning of 13th of May to exactly give you the right information, what you need to know about this. So if you're a property investor, mainly two changes have happened here. The government has said that there are major changes in negative gearing. You are not going to get a negative gearing in established properties anymore. But if you'll be buying a new built property, you will be getting still the negative gearing. That's one. Another thing is they have changed the capital gain tax rules. So what they are saying that we used to give you 50% discount previously on whatever profits you have made, but now we are not going to give you. We are going to do the indexation for that. So let's get into each one of them one by one. But there are people who will be watching this video, those who had bought investment properties but had no idea about negative gearing. So let's support them as well and give them what a negative gearing is. So what was it? Negative gearing is very simple. That let's imagine you had an investment property and you had bought this investment property for $800,000 and you paid 10% out of your pocket and 90% was the loan. That's how the property was. And this property was getting you a rent of, let's say, $550 a week. If this is the scenario, in this case, what was happening? So plus is you were getting the rent and minus is your expenses, your repayments to the bank, your council rates, your insurance, your maintenance of the established property, and if there was a depreciation, that will also be considered as a loss. So you get the rent and you have got all of these expenses. Usually when your numbers are like this, the gap is the gap in this could be up to, let's say, $30,000 loss per year. Now, if your salary was $150,000, if your salary was, and you are making $30,000 loss, it will be deducted from your income, and then you are only left with $120,000, and then you will be paying the tax on $120,000 instead of $150,000. So your tax bill will reduce. This is what the negative gearing was. And also to give you a high level understanding, it was never a good strategy for common people to get into this trap, because what this simply means is that you're simply buying a property for, let's say, $10 and you're making some losses on this property and you are getting a $3 back. You're still making a loss of $10 but getting a $3 back. Now these properties, if they grow, they cover up everything else. But if this was your intentions, this was absolutely wrong. And the government has said that if you are buying established properties, this is not going to work in anymore. Now, the next part, what I want to show you is established versus new build. Now, what the government is saying is that going forward from here, after 12th of May 2026, 7:30 p.m., if you are buying an established property, the government will not give you benefits of negative gearing. They have still mentioned that until the 30th of June 2027, you can still get some, but just for simplicity, keep it in mind that you are not going to get the benefits in the long term. For 1 year, it is going to be a couple of hundreds or $1,000s. I'm not really worried about that, but let's focus in here. And what they are saying is that when you're buying a new build, you will get the benefits of negative gearing, because what the government wants is, the government wants focus to go here, because Australia is anyways short of houses always. So they want people to build houses, they want people to buy houses, and if you are a property investor, this is what the government wants you to do. Now they have already, I've already explained you the carrot of the negative gearing. That carrot is already here. Now your other option, which is established properties. In the established properties, what simply is changing? So for example, you are buying an investment property in blue chip area. Blue chip area, South Yarra, Q, if you are in Melbourne, these are the examples. And let's say you're buying a property of 2.5 million. And this property you had bought with 10% your money and 90% was the loan. And if this property is going to give you, let's say, a rent of 1,500 a week, I have done my numbers. Right now we are in the environment of 6.5% interest rate. On interest only itself, you are going to be making losses of around $60,000 to $70,000 per year. It's a loss. So a lot of people who are wanting to get into the blue chip, they are not going to get the benefits of negative gearing anymore, and there will be a loss of $60,000 to $70,000. Now, what is your next best option? Your next best option is that you don't go here, but you go in different markets, and in different markets, what do you buy? So your next best option is that if you are wanting to buy an established property, what do you do now? Let's write it best option. Your best option is to go and find an investment property in a location wherein the growth will happen and try to get it under 500K. Because most of the people can afford this. For a 500K property, you want a rent of, let's say, 400 to 450 per week. Now, this is a scenario which is usually found in some parts or some units in metros, but regional, you can find this a lot of times. So 500K property getting your rent of 400 to 450. Again, the same scenario, 10% out of your pocket, 90% from the loan, and this property will be, let's say, in the loss of $15,000 to $18,000 per year. Now, in the previous case, the loss was $60,000. In this case, a loss of $15,000 to $18,000. If you can still bear, this is like $1,000 or $1,500 a month sort of loss. If you can bear that, then this is the way to go in. Now, most of the people will still be looking into established properties. Let me explain it to you why. Now, new build, your cost of building has already gone up. Your cost of building has already gone up because of the fuel rises and everything else. The time it takes to build up a house also takes long. And if you are wanting to build up a property portfolio like 1, 2, 3, 4, 5, 6 investment property, if you are going to go for new builds, it is going to take you anywhere between 10 to 12 years. Maybe slightly less as well. I don't know what would be your strategy. You'll be buying one here, one there. Depends how much cash you have. But it may take you a very long time to build up a portfolio of these many properties if you're going this path. Whereas if you're going on this path in established properties, you can really, really fast, quickly buy properties under 500. You can buy properties of 300K. Last week on Friday, I bought a property of $235,000, getting a rent of 280. I'm not saying that you go and do it, but I'm just letting you know that this is the cream. This is where you will be going. Now let's talk about CGT. The capital gain tax changes after the 12th of May 2026 at 7:30 p.m. Now, capital gain tax, I will explain it to you what is it in a bit of a detail, but it is applied on properties, shares, cryptos, ETFs. Mainly all the investments wherein you will invest money to make money. So it is applied on all of them. Now, going forward, what is the government saying? The government is saying that no more 50% discount. Let me give you an example. You bought a property in 2020 for 400K, and in 2026 you sold this property for 800K. So at a high level, you made a profit of around 400K, and the government will say previously that on 200K, no tax, and on 200K, I will add it to your income for that year and you will still be paying tax. This was a previous system and they have abolished it now. Now, inflation indexed model, what they're talking about is, same example, let's bring it in here. So you bought a property in 2020 for 400K and you sold that property for 800K in 2026. So what they are saying is that I'm not going to give you the 50% discount anymore, but in this method, what I will see is what is the real value of this property as per the inflation. Now let's say the value of this property as per the inflation, and inflation during this period was, let's say, 25% collectively together. And keeping that number in mind, now the value of your property in the current market according to the inflation could be 500K. So in this case, 500K minus 800K, now you will be taxed on 300K. So simple mathematics, you were previously taxed on 200K as a profit. Now you have got more profit in your pocket and you will be taxed on 300K. Now in this case, let's say the government got a tax of 90K out of you. In this case, they will get a tax out of you of 135K. So out of your pocket, you have paid about $45,000 more tax in this case. Now this is one of the scenarios. There are many scenarios. Sometimes it is better, sometimes this is better, but you don't have options right now. Your options are just like here. And this doesn't mean that you stop investing in properties. You have to stop shares, you have to stop crypto, you have to stop ETFs. In fact, you have to stop saving money. In fact, you have to stop working on your financial freedom. So this doesn't mean that you run away from property investing. It is just that whenever you are now buying houses, you have to be very careful. You have to understand the data, how things work. You need to understand the rental yields, and you have to understand the holding costs as well. Now, all of this simply means that you still keep on investing because that is the only way. And in fact, the properties is one of the finest way in history of Australia and will always remain so to grow your wealth. So whether you're doing shares, cryptos, EDS, or properties, you will be given this capital gain tax. There is no way for you to escape. Now, what you need to do is, if you are into the properties, you have to be very careful. You cannot just go and buy a property in Sydney anywhere because that is in your backyard. You cannot go and buy a properties in South Yarra and Q and sit on them and take the advantage of a negative gearing. That is not happening. And you cannot just go and buy a new build houses itself because you need to understand the risks associated with the builder. So many have gone bankrupt. So you have to understand all of this. And for this, what I've got for you is that you need to educate yourself. So I run a company called the Realta. We are a buyer's agency. We buy your property, and at the same time, we teach you the process as well. Learn and buy at the same time. So when you're going to be working with us, we are going to give you the access to the Realta Academy. Where do you get the data resources from? Where do you get how do you do the entire process start till the end? And you'll be learning everything, whatever you need to know. And it is pretty much very easy. You can get onto your Kajabi app. You can actually learn from best of the best people. Now this one is Gurminder Singh, who has developed the course. He's the head of research. And if you're going to be working with us, you'll be working with him and working with me as well. And I'm the lead strategist in the business. Take care of yourself. Speak to you.